High credit card bills, paying them off now using Velocity Banking and your 401k. When money goes from your employer into your checking account and it goes out and it dies. This math seems way too simple. We've been able to use the same dollar multiple times. Where else are you able to do that? To recap, we have stepped through a Velocity Banking example where I've showed you how a client of mine will be able to eliminate $40,000 in debt in 12 months. He's improved his credit score, improved his debt to income ratio, been able to put himself in a position to eliminate any purchase transaction problems that might come about, and he would have done all of this while making the exact same money. Imagine what purchase transaction problems you would be able to overcome by eliminating $40,000 in credit card debt, increasing your cash flow by $500 a month. Like, what could a bank possibly tell you? So if you watched my first video related to paying off high credit card bills using your retirement account and wondered, how is this even possible? This can't be true. How do you pay off $40,000 in 12 months? Well, you're in the right place. The question is, where do you fit in this equation? Are you disciplined enough to attack your debt? So I'm not going to spend a whole lot of time setting up this example. We kind of went over this already in my previous video. Millions are taking advantage of Velocity Banking to improve their credit profile. Whether that's to improve their credit score, improve their debt to income ratio, eliminate debt, or just freeing up cash flow to qualify for some competitive down payment. And for those of you who may be comparing your personal situation to this one, the key here is the process. Your income level does not matter. What matters is you knowing your numbers and deciding this is a priority. And what the hell is Velocity Banking again? Velocity Banking is a personal finance approach that uses the debt tool to leverage your disposable income to pay off debt, such as a mortgage or credit cards. So the idea is that you would use this debt tool as your primary operating account to pay your monthly expenses, similar to what majority of us use our checking account for. A visual of this process looks like this. Your regular income comes into your checking account. Then from your checking account, it's immediately transferred onto your debt tool. Now, once that income is on your debt tool, you have to do what? You have to pay bills. But one cool part about it is once your income goes onto that debt tool, it's satisfied whatever payment is due on that debt tool. And remember, there are many types of debt tools. The one that we are choosing to use is a credit card. It happens to be the highest limit credit card that my client has. And in addition, it's the credit card that has the largest payment. Once your income has been transferred to your debt tool, your bills can now be paid. And once those bills are paid, the remaining principal that's left over on that debt tool, it does a couple things. It pays down the balance on that debt tool. In addition, the cash flow that used to sit in your checking account is now sitting on the debt tool. And guess what? Next month you get paid again and you do it all again. That is the process of Velocity Banking. Ultimately, this process eliminates the needs for a savings account because all of those extra funds accumulated lives as principal on the debt tool and is used as principal payments to pay down the balance. And in the case of any emergency or big purchase need, that cash flow is still accessible on that debt tool. And I know what you're thinking. I can hear my cash people screaming now. What about emergencies? If I put all of my paycheck onto this credit card, I may have some cash emergency. It will be okay. I'll explain. Well, let's just start with emergencies. How many emergencies can be addressed using a credit card? I would say majority. But let's also say there is that moment, there is that instance where you need a large influx of cash due to some emergency. How do you get it? Well, remember, paycheck comes in, goes into your checking account. Then right in that moment before you transfer those funds to your debt tool, take the cash you need and put the rest in your debt tool. That's one way. But let's say this emergency comes about, you weren't able to plan for it, and your paycheck has already gone onto your debt tool, you have nothing left in your checking account. Then take a cash transfer from your credit card. And I can hear you. There's a fee associated with a cash transfer from a credit card. Whatever that fee is associated with taking that cash transfer will be minimal next to the impact that your income's going to have on driving down debt. And let me warn you, we will be getting into some simple math, and I promise it will not be complicated. Have my word on that. And if you remember, I hate the word remember. And if you remember from my prior video, my client's numbers are $6,000 a month. Expenses are $5,000 a month, and his total debt is $300,000 in total. This results in a cash flow of approximately $500 to $1,000 a month. That $300,000 in total debt is made up of a $225,000 mortgage, $40,000 in credit cards, and $35,000 being spent across 3 vehicles. Following this process will ultimately allow my client to be able to eliminate all of his debt in 5 to 7 years. That includes that $225,000 mortgage that he has. Now, I'm not suggesting that he does that. I'm not suggesting that you do that, but the possibility is there. And have you noticed? I don't show him making any more money than he started with 12 months ago. This is all based off his current salary and not changing any habits other than introducing this debt tool and paying all of his expenses from the debt tool. That is all he's had to do. See, we've all been taught when money goes from your employer into your checking account and it goes out and it dies. But if you really pay attention to what has occurred here, we've been able to use the same dollar multiple times. I want to make sure you connect to this. Here's what I mean. Your paycheck comes into your checking account. We immediately take that income and put it onto the debt tool. What does that do? The income that has been placed on that debt tool eliminates the need for monthly payment. Then we've taken that same dollar that's sitting on that debt tool and paid other expenses. We've used the same dollar twice. And I can make a case for using that same dollar multiple times. Where else are you able to do that? So let's jump in. We're spreading $20,000 in a self-directed 401k loan across $40,000 of credit card debt. We will then use one of those credit cards as a debt tool for Velocity Banking. The influx of $20,000 caused an automatic cash flow increase. He was paying $800 a month to credit card companies, but has cut that in half to $400 a month with the influx of $20,000 from his self-directed 401k loan. So don't forget he has to pay the loan back to himself, which equates to about $370 per month. So that's a total increase in cash flow of about $30 per month. Now, while $30 a month isn't that much, it's still an increase. So now we start Velocity Banking. And the Velocity Banking tool we're going to use to drive down that credit card debt is by using our $20,000 limit credit card, which we now have a $10,000 balance on. And if you remember, we took that original $400 a month payment for that credit card, cut it in half to now it's $200 a month. So income goes into his checking account, and then that income is immediately transferred over to the debt tool. And once that income hits that debt tool, what happens? Putting his income, and I do mean all of his income, that's all $6,000 of his monthly income onto his debt tool, does a few things. It not only knocks the balance down on the card, but it also satisfies that monthly payment for that credit card. What did satisfying that payment of $200 also do? It caused an increase in cash flow of that same $200 that now lives on that debt tool. So in total, that's an immediate additional cash flow of $230 a month, which brings his total cash flow from $1,000 up to $1,230 a month. And again, we've done this all within the first month. So let's step back for a minute. I do want to take a look at exactly what happens to this debt tool during month one. Because if you remember, he originally had a $20,000 maxed out credit card that he was paying $400 a month on. And then we came along and dropped $10,000 onto that credit card, which immediately dropped the balance in half and also cut that monthly payment in half. But then what happens? With Velocity Banking, he puts his entire income, his entire monthly income, a $6,000 paycheck, onto that debt tool, which then crushes that balance due, which drops it down to $4,000 and satisfies the monthly payment of $200. So therefore, that monthly payment has been satisfied by the influx of $16,000 onto that debt tool. But now what also has to happen during month one? We have to pay bills. We have to pay bills from the debt tool. So once he pays his mortgage, the other expenses, the cars, and the 401k loan, how much is that monthly expense? That monthly expense is now $4,770. So when you add $4,770 to the current balance of $4,000, that now increases the balance on that debt tool now up to $8,770. And then what happens in month two? In month two, he gets paid again. And we transfer that $6,000 from his checking account onto that debt tool. What does it do to that balance of $8,770? It cuts that balance down to $2,770. But we are in month two. In month two, we have to do what? We have to pay bills. So now we have to pay bills out of that $2,770 for a total of $4,770 added to that balance of $2,770, which gives us a brand new balance. And then what happens? Month three comes along and we do it all again. Income goes on to the debt tool. Knocks down that balance due on that credit card down to $1,540. So I do want to pause here for a moment and fully explain what has occurred. Do you see how he's continued to methodically reduce his overall debt while continuing to pay his bills? So now I want to jump to month 4. And notice, when he gets paid in month 4, it knocks the balance on that credit card down to $310. And then what happens? He has to pay bills. He pays his bills of $47.70, which now increases the balance on that card back up to $5,080. But do you see what's going to happen next? We come into month 5. In month 5, he gets paid, and then that income has to be transferred onto that debt tool. But how much is actually due on that debt tool? There's only $5,080 due. So instead of transferring the full $6,000, he's only going to transfer $5,080, which satisfies the balance. And once he satisfies that balance, what happens? The balance on that credit card is now 0. He has officially paid that card off at the start of month 5. So this is a moment of celebration for my client's discipline and focus. And if I'm not mistaken, he is exactly at this point right now. So anything I show you from this point forward will be what's coming. So although he's paid off this credit card, what does it now mean? This card is paid off, but now that means he needs more debt to go pay. See, this is a debt tool, also called a debt weapon. And what do debt weapons do? They attack debt. We just killed $30,000 in total debt in 5 months. And now we need to go find more debt. Huh? So let me stop here for a moment as well. What else are we able to take advantage of after eliminating a $20,000 maxed out credit card? What has occurred? Well, our debt to income ratio as well as our credit utilization has just greatly improved. How about reaching out to the credit card company that holds that debt tool and asking for a credit limit increase? Do you think they would be more inclined, based off your current utilization, based off your current performance over these last 5 months, do you think they would be more inclined to give you that credit limit increase? Of course they would. What excuses could they possibly have to not? Look at what you've done in this period of time. Or better yet, and why would you even want a credit limit increase, you might be thinking? Well, you definitely don't want it to use it. That is not the goal of getting a credit limit increase. What getting a credit limit increase does is it improves your credit utilization, which is a strong factor as to what makes up your credit score. In addition, it further improves your DTI, your debt to income ratio. And lastly, it further puts you in a much better credit-worthy position. You're much more likely for banks to look at you in more of a positive fashion than they were looking at you 5 months ago when you were struggling with $40,000 in debt with maxed out credit cards. The moral of the story here, after these 5 months of paying down this debt, there are nothing but wins to be had. But are you seeing that? So let's just say as a result of contacting the credit card company, you get your credit limit increased from $20,000 up to $25,000. This ultimately will allow you to take on more debt without maxing out your credit cards. And in turn will allow you to increase your cash flow, which allows you to pay that debt off even faster. Like there are nothing but wins here. But now back to month 5. If you think back prior to starting Velocity Banking, so prior to these 5 months, we had $10,000 between 3 credit cards that also needed to be addressed. And during the 5 months of Velocity Banking, contained within those $4,770 a month payments, we had a $200 a month payment for the remaining 3 credit cards. So if I made a payment of $200 a month for 5 months, that's a total of $1,000 that was paid on those credit cards during that 5-month period of Velocity Banking. So that's $1,000 that was paid against that $10,000 debt. So at the end of the 5 months, there's an approximate balance of about $9,000 left between those 3 credit cards. So how do we address the remaining $9,000? Well, we simply do a balance transfer of $9,000 from those 3 credit cards onto our debt tool. So if you think about it, any balance transfer usually incurs a fee. So worst case scenario would be we would transfer this $9,000 and have to add on a 3 to 5% transfer fee. Now I know what some of you might be thinking. A balance transfer fee? 3 to 5%? I don't want to pay 3 to 5% to transfer debt to another credit card. Doesn't make any sense. Why don't I just simply pay more onto that credit card debt to begin with? Why don't I just pay more to drive down the balance? Yeah, that's an answer. The best response I could give to this is if we continue to think and do as we've always done, we will continue to get the same results we've always gotten. Velocity banking is a process, meaning based off this current client's performance of attacking debt, how quickly do you think that $9,000 would be paid off if he did things the same way he had done them in the past? And think about that for yourself. How long would it take you to pay down this $9,000 in debt if you continue to behave like you're currently behaving? It's safe to say it will take a little bit longer than what I'm showing you here. And in turn, the amount of interest you could potentially incur would far exceed whatever it would cost for a 3 to 5% balance transfer. Trust the process. Why? Because it works. So my apologies for digressing. As stated, to address the $9,000 in remaining credit card debt, we will simply do a balance transfer of $9,000 plus the cost of that balance transfer to the debt tool. I'm just going to round it up to being a $10,000 transfer to the debt tool. So what has occurred here? The credit card we are using as a debt tool now has a new balance of $10,000 as of month 5. What also happens during month 5? Well, we have to pay bills. How much do we pay? Do we pay $4,770, which is the amount we were paying during the prior 5 months? No. Do you know why? Do you know why we are not paying $4,770 a month? Well, included in that $4,770 payment is a $200 a month payment for those 3 remaining credit cards. But what did we just do? We just paid off those 3 remaining credit cards with a $10,000 balance transfer to our debt tool. So therefore, there is no month 5 payment for those cards. Their balance is now 0. So that drops our previous monthly expense of $4,770 down to $4,570. But what else has happened here? Did you notice it? Our cash flow just went up. Our cash flow just went up by an additional $200 a month. So in 5 months, our cash flow has gone from $1,000 a month up to $1,430 a month. It's a $500 increase almost in just 5 months. But what happens in month 6? We do it all over again. $6,000 goes in, drops that balance from $14,570 down to $8,570. So I won't go into the remaining months from here. I believe you get the gist of where we're headed. It will ultimately take another 7 months to pay this $14,570 off. So at the end of the 12th month, my client would have successfully paid off $40,000 in debt while increasing his cash flow almost $500 a month. And I'm positive you have questions. For instance, how do you pay your mortgage using a credit card? The short answer to that is there's a way. Why? Because I do it. And I've been doing it for years. Some bills can't be paid by credit card. And most people who follow the velocity banking concept understand the unique steps that you may have to take in order to pay those bills that aren't initially allowed to be paid by credit card. But the short of it is it's possible. It's very possible. Some of you might incur an overdraft charge in order to pay your mortgage by credit card. And some of you might have to reach out to the mortgage company that services your loan and just ask to be allowed to pay by credit card. It can be done, and I can show you how. And again, think about the impact that we're not even talking about. The impact to his credit profile, the impact to his debt to income ratio. Imagine what purchase transaction problems you would be able to overcome associated with the purchase of a primary residence or even an investment property. By eliminating $40,000 in credit card debt, increasing your cash flow by $500 a month, like what could a bank possibly tell you? Bottom line though, there are many ways to overcome challenges associated with the velocity banking process. We just have to critically think through them. And there is no reason to step outside of the process. Why? Because it works. $40,000 in 12 months speaks for itself. Imagine how much quicker this process would go if we did include what he had in savings, or what he received in his income tax return, or if he got a bonus through his 40-hour-a-week job, or a side hustle that's producing some income. There's many ways to make this happen. And the best thing for you to do is just to reach directly out to me, and either I will help you specifically, or I will direct you to the gurus that I've worked with in the past who showed me how. From time to time, I will do examples like these. If this was helpful or not, Please provide me that feedback. And if you want to see more examples like this, please also let me know that. My hope is that you received value from this set of videos related to velocity banking. Please like, subscribe, and comment below. But more importantly, please share this with someone who can get value out of this content right now. We do not want to go into 2021 riddled in debt. Now is the time to take advantage of some of these gains to be able to pay down this debt and pay it down quickly. And I will show you how. I'm Donnell. This is Self-Directed Investment Strategies. I appreciate your investment in me and this channel. So until next time. Later to say. I don't know how to end it. Sorry.